Hello again, everyone. Thanks for tuning in this week. Welcome back and welcome to The Matrix. I thought this was a fitting background considering this crazy real estate market and this crazy economy we're living in with all this uncertainty and whatnot. Also, if you haven't noticed by now, I did update my home buying recipe. I will get into that later on in the video. But first, I want to talk about the announcements from the Bank of Canada and the government regarding immigration from last week and how they pertain to housing and what they actually said about housing in those news releases. So let's check them out now. Starting with the Bank of Canada's announcement, of course, they did drop their interest rate by 0.5%. It's not going to affect fixed mortgage rates at this point, but there's a lot of flip-flopping and non-answers, in my opinion, when it comes to housing. But listen to a few clips and you'll see what I mean.
The bank forecasts inflation will remain close to the target over the projection horizon. The upward pressure from shelter and other services is expected to gradually diminish. With stronger demand, the downward pressure on inflation is also forecast to dissipate, keeping the upward and downward forces roughly in balance.
Well, it seems like TIFF has all the bases covered as upwards, downwards. Everything's going to be balanced. But he did say, of course, housing or shelter inflation is coming down. It's currently sitting at 5% here. Let me just throw this on here. And it is the biggest portion of inflation right now. But he does say it's coming down, but he's kind of double talking there. There's upwards and downwards pressures and whatever else. It's kind of very confusing. Anyway, let's continue on.
We also expect growth in residential investment to rise as strong demand for housing lifts sales and spending on renovations.
All right, so housing's going back up, sales are up, renovations are going up, so that's going to help with demand in the housing market now. So we've got inflation on housing coming down on shelter, but demand increasing so far.
But overall, inflation is expected to remain close to target over the projection horizon, as upward pressure from shelter and other services gradually diminishes and excess supply in the economy is absorbed. On the upside, lower interest rates could fuel a stronger rebound in housing activity, or wage growth could remain elevated relative to productivity.
All right, so now we're fueling a stronger rebound in housing activity. Wouldn't that mean upward pressure on housing or shelter inflation? So it kind of flipped the other way. So I think they're kind of trying to cover both sides of the equation here. Of course, people listen to these statements and will hold them accountable. But so we have inflation coming down, but then upward pressure. So again, a lot of back and forth when it comes to housing.
Yeah, I wanted to ask about housing. You cited it as a main sort of risk to the outlook. You cited new mortgage rules introduced by the federal government, pent-up demand, and lower interest rates. Can you expand on how you're weighing those worries in your deliberations?
As you know, we've been watching housing closely. It's one of the most interest-sensitive parts of the economy, so it's always a sort of a leading, an area of the economy that responds quicker to changes in interest rates. In our forecast, we do have a pickup in housing. It is possible that the combination of lower interest rates and changes in mortgage rules could mean that pickup happens sooner or faster or stronger than we expect. It's also possible people will look at the direction of interest rates and sort of stay on the sidelines a bit longer and wait for rates to come down more. And we don't see that pickup happen as fast or as strong as we're anticipating. So we'll keep watching it closely.
All right, so not a definite outlook on housing here. It seems to be like shelter inflation's coming down, and but they do expect an uptick in housing sales, in demand. But at the same time, maybe people are going to wait longer because they see interest rates coming down. So not a very good answer here, and they're kind of double talking. They are actually double talking on this. So nothing I really took away from that I can say was good information. And it's just the perfect one was the first time or the first clip I showed there of Tiff Macklem saying upward pressures and downward pressures. He's like saying it in the one sentence, up and down, and it was just like so confusing. Anyway, let's listen to what the immigration announcement was last week and how that may affect housing and my take on that also. So this week I'm not going to torch you with listening to Trudeau. He's already said his piece of virtue signaling. We're going to listen to Mark Miller, the immigration minister here.
As mentioned in our recent history, it was key to increasing our gross domestic product, net entrance into the workforce, particularly coming out of COVID, even going into COVID. We had labor shortages.
So, of course, the first thing he said there, the reason they had such high levels of immigration was to increase GDP. That's what it was for. It wasn't to help immigrants from certain countries come to a better country for a better standard of life. It was literally to increase GDP so that we could stay out of a recession. That was why they brought in a massive amounts of people. It wasn't sustainable, and now we have to deal with the repercussions of that. But yeah, it was like human modern day slavery. I've said this before. Bring you in. We need your money to make our country looks like it's doing better than it is. It's terrible, but he just admitted it, and they've admitted this many times. This is not trying to dissect words and take them out of context. This is the truth and the reality around why they did boost immigration, but now they got to bring it back to normal levels because they've done taking people's money.
The lower permanent resident targets, as well as the temporary resident targets that I will speak to in some length in the next few minutes, will have and are expected to impact the housing supply gap by about 670,000 units by the end of 2027. That means that we will not have to build an additional 670,000 housing units by that time. This is significant.
Woohoo! We just went from building 4 million units by 2030 or whatever that time frame was, I think it was 2031, to cutting off 670-something thousand less now by 2027, that is. So now that we've reduced immigration, the government's saying we don't have to build as many homes when they haven't built any yet, or they don't build any. But yeah, conveniently enough, the pressure on housing was so immense, they had to literally cut off immigration.
So the measures that we instituted a little less than a year ago are ones that are important to highlight the success of. We have seen, thanks to those measures, a reduction of about 43% in the number of new study permits accorded, and that's working. Studies are showing quite consistently that is contributing to the lowering of the rent, notably in Vancouver, Surrey, as well as Toronto, close to 8 to 10%.
So this is the second time we've heard this now in a couple of weeks. The first time was from Chrystia Freeland, and now we're hearing it from Mark Miller. Rents are coming down. 8% or so in Toronto. I've actually talked to a leasing manager in my area, and she confirmed with me this week, just yesterday on a meeting, that rents are coming down also around here and in the area she services. So I just want to know, like, how will that impact investors that bought these properties, or the investors that are barely or not covering their bills on these homes? They're getting less and less. It's going to mean more supply into the market, more homes coming to the market, and they know this too. They know that the supply is going to come from these investors or from people that can't pay their bills.
And we will continue to listen to Canadians. That's something that's important because the people standing behind me today are people that have been speaking to their constituents, have been speaking to economists, have been speaking to universities and institutions, and listening to their own families. And they've said,
so this is hilarious. So the people standing behind him, I've never seen any of these people. So usually when they come out for one of these press releases or these conferences, they come out with their cabinet ministers, right? So these people are not cabinet ministers, but usually it's all the cabinet ministers or their certain select ministers behind them. These are backbench MPs. And because this is an immigration announcement, they have all the immigrants that they could find in their cabinet or in their party. Sorry, not in the cabinet. They're members of parliament, these people. Never seen them before. They've never brought them up before. And here you have two white guys standing at the front making the rules and all the immigrants behind them. I think it's just insane. Like, it's so absurd. And this typically speaks to the mentality of this government. They like to pretend that they put all the minorities first. But there you have it. Two white guys in the power standing at the front with all the immigrants behind them saying, yeah, we listen to them. This is the first time they've actually listened to them because I've never seen any of these people standing behind them at one of these announcements before.
For the number crunchers out there, and I know there are indeed a few, the temporary measures that we have taken, including the ones that Minister Boissonnault has announced, are expected to result in a reduction of Canada's temporary resident population of 445,000 in 2025, an additional 445,000 in 2026, and perhaps a modest increase of 17 in 2027. Those are the numbers that we are factoring in as we look at the impact on the need to build housing units.
So very specific on that right there. So these are just a temporary. So a reduction of 450,000 next year, Minus the permanent immigration numbers, they went from 500,000 to 395,000, so 105,000. So we have 500,000. So they've literally cut immigration in half. We went from around 1 million, actually it was over 1 million, to 500,000 now. It's actually 450 plus 105, so more than 500,000. So they've cut it all in half, and they're now saying, well, we don't need to build the homes, because they know they're not building the homes, and there's a big issue there. And this is all to do with housing. The Bank of Canada's announcement and this announcement is all to do with housing, which is insane. And they're worried about it. They're worried about the economy. They're not just worried about people being homeless, but they're worried about the overall economy and where it's going to go. And there's a recession brewing, and they know it. So now that we're done with that, let's get into some charts. Let's start with the home buying recipe. I have a big update on it today, so let's get right into it. Okay, so here we are. We have another bar added to falling rates after that jumbo 0.5% interest rate cut by the Bank of Canada there. There it is. We now have, 4 bars, almost a full battery on the falling rates. Of course, falling prices, we do have the full bar. I've had some people question me on this, but look, we went from a high point. Every year, the highs are getting lower. I know the lows have gone up a bit, but they've been stable for the last 2 years. But every year on the highs, prices are falling. If you want to argue that point that they're not falling, I think I'd say you're insane, because they're clearly falling. And down to the unemployment. The unemployment, 6.5%. Nothing changed there. And of course, mortgage arrears and delinquencies from the big 11 banks that report this, still relatively low. But let me get into what it's going to take to move these battery bars to the next level here. So starting with the falling prices, in order for me to take away a bar on that, we'd have to see year-over-year increases for the yearly highs, right? And I'm talking the peaks. So we went from, 815 in 2022 to 740 or 750 in 2023. Then we're barely over 7, about 720 or 710 or something. These are national numbers this year. So yeah, prices are falling, and unless we see a new yearly high, we're not going to take any bars off of that. Falling rates, we're going to have to see another couple of regular rate cuts, or maybe another big jumbo rate cut, and we'll fill that right up. So that could happen next month. These things, again, they're filling in quick. When it comes to unemployment maintained its bar status or its battery status, because it would have to drop below 6.5, and I will take a bar off of that. But once it reaches 7%, it's getting another battery bar added to it. And of course, lastly, the mortgage arrears and delinquencies there. We're currently sitting at 0.2%, still very low. I've drew a trend line there at 0.23%. And that is the previous lows. So they've risen from our previous lows, which is why they have one battery bar. Once they reach that 0.23, which we're at 0.2 right now, so not much further to go, I will add that second battery bar, and then sky's the limit most likely after that. So yeah, hopefully that makes sense to you guys to kind of confirm my methodology. I'm not just making this stuff up. There is a method to my madness. So that's all fine and dandy, but what if I'm wrong, right? That's the question. What if I'm wrong? Now, I've used these major indicators and major trends to ensure my accuracy as much as possible, but what if I'm wrong? Well, let's look at a couple of scenarios here to see what if I am wrong. Okay, first let's start off with this. This is just the average sales price in Canada, the national average sale price. And looking at it here, of course, we've shown this chart many times, but I just want to make one comment here about any of the realtors that say, get into the market now because prices are going up, or people like myself that says prices are going down, and who's right and who's wrong previously, right? And we've both been right and we've both been wrong, because you can see there, 2022 prices went down, 2023 prices went down, this year prices went down. And of course, for all the realtors telling you interest rates just went down, you should buy now because it's going to heat up, the market's going to heat up, get in, now's your chance. Well, they're also right, because look, prices do go up. They've gone up 4 times in the last few years, and that's because we see seasonal uptick and the volatility in the market. But they went right back down. So that's like me saying, get up and get some sunshine because the sun's going to go down soon. Well, it's going to come up tomorrow, right? So we're not seeing any immediate breakouts in either direction. So when someone tells you get into the market because prices are going up, they're probably right, but they're not talking about the long term here. I'm talking about the long term trend and where they're going to break out to. So let's get into that now. We're going to get into 3 scenarios. What if they go up? What if they go down? And what if they stay the same, right? So let's start off with them going up. I'm just going to move myself over a bit here. So yeah, looking at this trend line, this is the mean line, right? This is the long-term mean. It's a very important line, probably one of the most important lines or trend lines that you can use in these average prices in this housing data. And yeah, so if prices went up, if they're going to go up, they're going to go up. They're not just going to go up to the previous highs like they did in the spring. People, when they say prices are going to go up, we're assuming they're going to go up back to where they were in 2022 or somewhere close to that. And that was 815,000. Look what that does to our trend line. It just puts it right out of whack. You're going to be at $1 million in 5 or 10 years from now for the average price in Canada, and all the other stuff or all the other prices and all those other years become completely irrelevant. We just totally break this trend, which is highly unlikely. And think about what's going to happen to our purchasing power and inflation and everything else. It's just not realistic to project that prices will just go up, right? It just doesn't make sense. It doesn't fit with any trend, and it's just speculative hearsay at this point. Let's move on to our next scenario. This is if prices actually go down in the short term. Now, looking at the mean line here, the long-term mean line, you can see it sticks with the trend, right? That mean line is still in place, and I've highlighted some key levels here. So looking at those yearly lows recently, which is the top, and almost back to 2021, that one before the big spike there. But looking at the yearly lows, besides the big one after 2022, but you'll see 650. You see a lot of resistance there at 650. Again, the economy is good. We're not in recession yet. They've been boosting immigration, bringing in all these immigrants to pay for our lives and to keep GDP rocking. So, of course, things have been relatively good considering the circumstances. The next support and resistance, it's actually both, would be 600,000. That's a big one. And you can see we dipped down to that right after the big 2022 drop in prices, and of course rebounded in the spring shortly after that. And even previously to that in 2020, that was a big resistance level there too on the way up. Then we look at what happens. Okay, this is what happens if prices break down, recession happens, and all those buying indicators line up, mortgage arrears and all the rest of that, high unemployment. Look, it's going to drop below that long-term trend line. It always drops. Look at all the places previously in history. 2008, it dropped below it many times throughout there. 2013, 2014, 2017, 2018, or it was 2018, sorry, 2019. So there is, prices go up, prices come down. Recessionary pressures affect that dramatically. So we could reach 550 very easily. That's just a little bit below that long-term mean line, and that would be in 2025 and 2026. Again, with my previous predictions, I did say anytime after the fall, starting right now, we would probably see all these things fall in line, and they are coming close. So keep an eye on that. Lastly, what if prices just stayed flat? They did their seasonal up and down like they've been doing here for the last couple of years, but prices stay flat. It's like an allowance, right? When you were a kid, this is what happened. Your parents gave you a yearly allowance instead of like weekly or monthly. You went out and spent it all, and this is what's happened. And there's going to be no recession, but things will just stay flat, and this is what will happen. By 2029 or so, we will still be at the same levels we're at now, which is 680,000, and it fluctuates between seasons. And that's how long it will take the economy and our wages and growth and whatnot to catch up to these prices. So prices will remain flat for the next 5 years. And this is, again, very likely. Even if we do have that dip, prices will be flat and will be on the same trajectory. So this is, again, is what happens if prices remain flat. And this is the best case scenario for that. So let me know what you think in the comments. Do you think prices will go up and fundamentals out the window, trend lines out the window, forget about it all? We'll literally be living in the matrix, sitting in apartment buildings, living a fake life. Do you think prices will go down once we hit a recession? If we hit a recession, it looks like we are, but do you think they'll go down when unemployment rises and all of these battery bars fill in? Or do you think prices will remain flat for an extended period of time until 2029 or 2030 or so. Anyway, thanks for watching, and I'll see you in the next one.